In this video, I'm revealing the 7 assets W-2 earners quietly buy year after year. Assets the IRS would love for you to ignore because they legally cut taxes, build serious wealth, and stop you from having to donate your hard-earned money to the IRS. After helping over 250 high-income W-2 earners save over $12 million in taxes just in the past 12 months, I keep seeing the same exact thing. It's not what you're earning, it's what you're buying and in the order that you're funding it that matters. Most people overpay by picking the wrong assets or the right ones in the wrong order. Today, I'll show you the 7 assets high earners buy, plus the order to fund them, so you can cut $50,000 to $100,000 off your tax bill, hit $1 million in tax savings sooner, and stop tipping the IRS your hard-earned money without any control of it. Let's start with asset number 1, a workplace plan Roth expansion. Most big company plans quietly allow this, but almost no one's going to tell you about it. After you get your regular 401k match and deferral, you can add after-tax non-Roth dollars up to your plan's annual cap. Then convert those after-tax dollars to a Roth the right way, inside the plan or out to a Roth IRA. That opens a much bigger Roth bucket, so future growth can be tax-free under current rules. All you need to do is ask your HR if your plan allows after-tax contributions, in-plan Roth conversions, or in-service rollovers, whether you can convert each payroll or monthly, and that the plan tracks sources separately. Don't confuse the Roth 401k deferrals with after-tax contributions. They're different buckets. I have a full video on my YouTube that covers this in more detail, so if you're still unsure, check that out after this video. Now let's add a second tax-free bucket outside of work. If your income is too high for direct Roths, there is a backdoor way. You place your money into a traditional IRA, then convert it to a Roth IRA. It's that simple. If you already have pre-tax dollars sitting in IRAs, roll them into your 401k first so your conversion stays clean. Convert promptly and keep your paperwork tidy. The result of this, another stream of tax-free growth working in your favor. We've built 2 tax-free engines. Here's a third with a twist. Are you on a high deductible health plan? The HSA is one of the only accounts that wins 3 ways. Tax deductible in, it grows tax-free, and you can withdraw it tax-free for qualified medical expenses. You don't just let it sit in cash, you invest it. Pay small medical bills out of your pocket, save your receipts, and reimburse yourself later while the HSA compounds. In retirement, HSA dollars can cover things like Medicare premiums and long-term care costs. Use it for medical to keep the triple tax benefit for non-medical, know the age rules. Next, you need a flexible bucket for RSUs, bonuses, and life in general. This is your flexible liquid engine. You can use broad index funds or direct indexing, practice tax loss harvesting, harvest paper losses in down periods to offset capital gains, and up to a slice of your ordinary income each year, and bank the rest for later. Hold your positions ideally for 12 months, when you can use that for long-term capital gains rates and avoid wash sales by not buying the same fund within 30-day window of any account. This is how you make a taxable account act tax smart without getting super fancy. So far, we've built tax-free growth and flexible money. Now let's add a lever you can create big legal deductions that actually matter to W-2 earners. Real estate gives you depreciation, a paper loss that lowers your taxes. A cost segregation study can pull more of that loss forward much faster. Normally, rental losses are passive and don't touch your W-2 income and wages. But there's a clean lane, short-term rentals. If your average guest stay is 7 days or less, you material participate, aim for over 100 hours and more time than any helper, and the property's placed in a service, which means it's furnished, listed, it's available to rent, and you properly document your short-term rental losses, this can be treated as non-passive. That means that can offset your W-2 income when filed correctly. Keep simple logs, bookings, guest messages, turnovers, supply runs, vendor coordination, track your hours versus the cleaners or other co-hosts. Do it right, and this becomes one of the few legal ways a high W-2 earner can use real estate losses today to offset their W-2 wages. If you're not into hosting or operations, here's the more hands-off real estate path. If you want real estate without running it, use multifamily, storage, industrial partnerships, and different funds. You can get professional management, often large year-one passive losses on your K1. Those losses can offset passive income and gains, and you can carry them forward. Know the trade-offs. These are illiquid, manager quality matters, and K1s arrive sometimes on their own timeline. Pair them with other passive income or future property sale for strong tax outcomes. Again, I have a full video going over how to use real estate to lower your taxes come the end of the year, so if you have not already, check that out after this video. Up to this point, we've covered how to create more growth, take more deductions. Now let's stabilize your income income and be more tax aware. You're probably donating already, so let's make it tax efficient. You can give appreciated stock or ETFs you've held over a year to a donor advised fund. You avoid capital gains on the growth and get a charitable deduction at fair market value this year. If you bunch a few years of giving into one tax year, you can clear the standard deduction and actually itemize. Then you grant to charities from your DAF on your schedule. Remember to keep receipts, know the AGI limits, coordinate with your CPA and financial advisor. I did not list these at random. This is the order I recommend you stack them. So just to repeat, start with your workplace plan and expand the Roth space. Mega Backdoor Roth, a Backdoor Roth IRA, and the triple tax HSA. Build a tax-aware, taxable account for flexibility. Layer real estate, active short-term rentals if you want hands-on deductions or passive funds if you don't. Finish with a DAF to turn generosity into real deductions. Follow the sequence and more of every paycheck compounds for you, not the IRS. In other words, you can lower your tax bill by $50,000, $100,000, and most importantly, build long-term wealth. Quick reality check. Most high earners see a list like this and think, I don't understand anything. This is way too much work. I'll deal with this in April, but the reality is you never end up doing anything. And you are just tipping the IRS another $50,000, maybe $100,000 this year. And that's why I founded Tax Saving Experts, to help high-income W-2 earners actually lower their taxes, keep more of what they earn, and build real long-term wealth. In the last 12 months, we've helped over 250 of our clients and W-2 earners legally save over $12 million in taxes using personalized strategies specific to them and their situation. So if you want my team to do the same for you and actually cut your tax bill and build lasting long-term wealth, book a strategy call using the top link in the description. But if you'd rather keep learning first, check out either one of these next videos. Cannot wait to connect soon.